Hello friends! Welcome to our channel, American Systems Explained! Understanding credit scores in the United States can feel like trying to read a map without a compass. Many Americans know that credit scores are important, but few understand how they are calculated, what affects them, or how they influence everyday financial decisions. In this video, we'll break it all down step by step, starting from the basics. Part 1. Beginner. Foundations of credit scores. What is a credit score? A credit score is a 3-digit number that represents a person's creditworthiness, the likelihood that they will repay borrowed money on time. In the US, most credit scores range between 300 and 850. A higher score generally signals lower financial risk to lenders. Credit scores are widely used by banks, credit card companies, landlords, and even some employers to assess financial reliability. Why credit scores matter in the US? Credit scores influence interest rates, loan approvals, and even insurance premiums. For example, a person applying for a mortgage with a score of 780 might qualify for lower interest rates than someone with a score of 620. In addition, a strong credit score can make it easier to rent an apartment or secure a utility service without a large deposit. Key components of a credit score. There are 5 main factors that determine a credit score in the United States. 1. Payment history, 35%. Payment history is the single largest factor. It reflects whether you pay your bills on time. Missed payments, late payments, or accounts sent to collections can lower your score. Example, paying a credit card bill late by 30 days may drop your score, whereas consistent on-time payments gradually improve it. Engagement trigger. Asterisk. Did you know even a single late payment can stay on your credit report for up to 7 years? 2. Amounts owed credit utilization, 30%. This measures the percentage of available credit you are using. Keeping balances low relative to your credit limits is beneficial. Example, if you have a $5,000 credit limit and a $1,000 balance, your utilization is 20%, which is generally considered healthy. Mini recap. Payment history matters most, but how much you owe relative to your credit lines also significantly affects your score. 3. Length of credit history, 15%. Lenders prefer to see a long, consistent credit history. Accounts that have been open for many years contribute positively. Example, someone with a credit card open for 10 years will usually have a better score than someone with a card open for 1 year, assuming both maintain timely payments. 4. Credit mix, 10%. This considers the variety of credit accounts, credit cards, installment loans, mortgages, auto loans, etc. A mix shows lenders you can handle different types of credit responsibly. Asterisk, did you know? Having only one type of credit may limit your score growth, even with perfect payments. 5. New credit inquiries, 10%. Every time you apply for credit, a hard inquiry may occur, temporarily lowering your score. Opening multiple accounts in a short period can be seen as risky behavior. Example, applying for 3 credit cards in 2 months might cause a small dip in your score. How credit scores are calculated in the US. Both range from 300 to 850, but weigh factors slightly differently. FICO scores are the most widely used by lenders. The calculation is algorithmic. Each factor is assigned a weight. Historical data is analyzed, and the resulting score represents the predicted risk of non-payment. Visualization tip. A bar chart showing the 5 factors with their percentage weights can help viewers understand at a glance. Checking your credit score. You can access your credit report and score from the 3 major credit bureaus, Experian and TransUnion, once per year for free through NOLcreditreport.com. Some banks and credit card companies also provide free monthly FICO or Vantage scores. Practical beginner examples. Example 1. Jane has a single credit card with a $2,000 limit and carries a $1,800 balance. Despite paying on time, her credit utilization is 90%, which can hurt her score. Example 2. Alex just turned 18 and opened a student credit card. He pays $50 of his $500 limit each month on time. Over a year, his on-time payments, and low utilization, start building a positive credit history. Tips for beginners. 1. 2. Keep balances below 30% of your available credit. 3. Avoid opening too many new accounts at once. 4. Check your credit report annually, for errors, mistakes can affect your score. Mini recap and engagement questions. What are the 5 main factors affecting credit scores? How does credit utilization differ from total debt? Did you know that even without debt, your score can be low if you lack a credit history? Visualize your own credit mix. Do you have only credit cards or a combination of cards and loans? Understanding these basics sets the foundation for deeper insights into how credit scores influence financial decisions in the US and the practical steps anyone can take to manage them responsibly. Deepening your understanding of credit scores. Now that we've covered the basics, let's explore how credit scores work on a deeper level, looking at cause and effect relationships, nuanced differences between models, and practical scenarios US consumers face. How different credit models affect scores. While FICO and VantageScore both range from 300 to 850, they differ in how they weigh certain factors. FICO scores: payment history, 35%; length of credit history, 15%; new credit, 10%; payment history, 40%; and credit age, 21%. This explains why your FICO score may differ slightly from your Vantage. Lenders usually specify which model they use, so the score you see from a bank may not be exactly the one a mortgage lender considers. How credit events influence scores over time. 1. Late payments. A single 30-day late payment can reduce a score by 60 to 110 points. Depending on your starting score, subsequent on-time payments gradually recover your score. Practical scenario: Sarah missed a car loan payment once, dropping her score from 720 to 650 over 6 months of consistent payments. 2. High credit utilization. Maintaining high balances can indicate financial stress to lenders, even if you pay bills on time. Scenario: Mike has 2 credit cards with $5,000 limits each. He carries a combined $6,000 balance. 3. New credit applications. Multiple inquiries in a short period signal higher risk. Some scoring models differentiate between rate shopping for auto loans or mortgages and multiple credit card applications. Scenario: Lisa applies for 3 credit cards in 1 month. Her score drops slightly due to hard inquiries, but inquiries for a mortgage within 30 days count as 1, minimizing impact. Credit mix and its strategic use. A balanced credit mix demonstrates financial responsibility across different types of debt. Example: Tom has a credit card, a student loan, and an auto loan. Despite a 680 score initially, his credit mix improves his score over time to 710. Visualization idea: pie chart showing different account types and their contribution to credit health. Understanding credit age. Average age of accounts matters. Older accounts show a long history of responsible management. Opening new accounts lowers average age, potentially reducing score temporarily. Scenario: Emily has 2 accounts opened in 2010 and 2012. She opens a new card in 2023. Her average age drops slightly, but long-term history still helps maintain a solid score. Interpreting credit reports. Credit reports provide the detailed data behind your score. They list accounts, balances, payment history, inquiries, and public records, such as bankruptcies. Regular review helps spot errors that could unfairly lower your score. Engagement question: have you checked your credit report this year? Mistakes happen more often than you think. Cause-effect examples in everyday life. 1. Renting an apartment. Landlords often run credit checks. High utilization or late payments can result in higher deposits or denial. Scenario: a renter with a 580 score is asked for a $1,500 deposit, whereas a 720 score tenant might pay only $500. 2. Lower scores lead to higher rates, increasing total costs over the life of a loan. Example: on a $25,000 auto loan. 3. Credit card benefits. Higher scores may qualify for cards with better rewards and lower interest rates. Scenario: an individual with a 780 score can access a card offering cash back and 0% intro APR, which a 650 score applicant would likely be denied. Practical tips for US consumers. 1. Monitor your credit reports regularly. 2. Maintain credit utilization under 30%. 3. Avoid unnecessary hard inquiries. 4. Diversify types of credit over time, but don't open accounts purely for score improvement. 5. Pay attention to older accounts. Closing old accounts can shorten your credit history. Mini recap and engagement triggers. Did you know that a single missed payment can drop your score over 100 points? How does a mortgage rate shopping window differ from multiple credit card inquiries? Visualize your own credit mix and age of accounts. What strategies could help maintain or improve your score? By understanding these intermediate concepts, US viewers can see not just what affects credit scores, but why, and how specific financial actions create predictable results over time. Advanced understanding. Mastering credit scores in the US. At this stage, we'll explore advanced insights into credit scores, long-term consequences of financial decisions, and actionable takeaways for US consumers seeking to understand the deeper mechanics behind creditworthiness. Advanced mechanics behind credit scores. 1. Compounded effects of credit behavior. Credit scores are dynamic. Each financial action has both immediate and long-term effects. Example: missing a payment drops your score, but consistent on-time payments afterwards slowly restore it. Conversely, repeated minor late payments compound, causing a steeper decline. 2. Debt-to-income ratio, DTI, versus credit score. While not part of your credit score directly, DTI influences lender decisions alongside your score. A borrower with a 750 score but a high DT, I may still face loan denial due to risk of overextension. Scenario: Michelle has a 780 score but carries a 50% DTI. A mortgage lender may require a smaller loan or higher interest rate compared to someone with a 720 score but a 30% DTI. 3. Credit score, decay and recovery. Certain negative events have lasting but decreasing impact over time. Examples: collections, charge, and bankruptcy stay on reports for 7 to 10 years, but their impact diminishes as time passes and positive behavior accumulates. Visualization idea: timeline diagram showing score impact over years after a negative event. 4. Strategic use of credit cards and loans. Responsible use of multiple accounts can accelerate score growth. Rotating balances, paying in full, and maintaining low utilization signals. Strong financial management. Scenario: John has 3 credit cards and an auto loan. He pays each card in full monthly while keeping utilization under 20%. Over 3 years, his score improves from 680 to 780.5. Long-term consequences of poor credit management. Poor credit can increase loan costs for decades. High interest rates accumulate, making mortgages, auto loans, and even rental applications more expensive. Example: over 30 years. A person with a 620 score may pay tens of thousands more in interest on a mortgage than someone with a 740 score. 6. Advanced monitoring tools. Beyond annual reports. Many US consumers use credit monitoring services that track changes in score, alert for inquiries, and detect potential fraud. Some apps simulate how specific actions, like paying off a card or opening a new loan, could change your score. Actionable takeaways for advanced management: maintain on-time payments, even small, consistent payments prevent score decay. Strategically manage credit utilization. Keep balances low, especially before major credit applications. Use credit mix wisely. Loans and revolving credit show capability to manage different forms of debt. Monitor regularly annual credit reports, plus periodic monitoring help catch errors early. Plan for Long-term goals. Consider how actions today like closing accounts or opening new loans affect your credit 5 to 10 years ahead. Summary of key points. Credit scores reflect both historical and current financial behavior. Payment history and utilization have the largest immediate impact. Credit, mix, and account age contribute to long-term growth. Negative events have decaying impact. Positive behavior rebuilds credit over time. Strategic monitoring and management are essential for maximizing financial opportunities. Mini recap and engagement triggers. How do negative credit events decay over time? What strategies can accelerate score recovery after missed payments? Visualize your personal credit timeline. Which actions will compound positively or negatively? We hope this video was worth your time. If you found it helpful, please like, subscribe, share, and leave a comment below. Your feedback helps us create more content like this. See you in the next video.